This video will help you understand the concept of rental property depreciation recapture and its implications. You can also learn how to manage and calculate it effectively. Check out the full details by visiting the link in the description. Depreciation recapture, an expensive misunderstanding. There's no shortage of voices out there claiming that real estate is the ultimate path to wealth. I call them fake gurus. They'll hype up the amazing tax benefits, often giving the impression that depreciation somehow exempts you from paying taxes. But here's the truth that many of these so-called experts either don't know or conveniently leave out. Depreciation isn't tax-exempt, it's tax-deferred. And the reality of what that means can hit hard, especially when it's time to sell. I know this from personal experience. After decades of owning rental properties, I've had to write several huge checks to the IRS, all thanks to depreciation recapture. It's a real expense, and it can be a shock if you're not prepared for it. When you claim depreciation on your rental properties, you're essentially lowering your taxable income each year, which feels like a win. But when you sell, the IRS comes knocking, asking for its share of the tax you deferred. That's when you realize that the benefits you enjoyed during those years weren't free. They were just delayed. The tax hits I've faced after selling properties were substantial, enough to make any investor rethink the so-called tax benefits of real estate. This isn't to say that real estate can't be a profitable investment. It can be, but it's important to understand the full picture. The long-term costs, including depreciation recapture, are real and can significantly impact your net profits. Before you dive into real estate thinking it's the secret to untold wealth, make sure you understand the tax implications fully. It's not just about the money you make. It's about how much of it you get to keep after the IRS takes its share. Luckily, you found my page. I'll share with you the realities of real estate investing and the path to financial freedom. Rental property depreciation recapture, what is it? Simply put, rental property depreciation recapture is a tax provision that the IRS has set. Primarily, it ensures that real estate investors pay capital gains tax on the amount of the property's depreciation that they claimed during their ownership period. This is a critical concept for real estate investors, as it directly impacts the net profit they gain from the sale of a property. In simple terms, the Internal Revenue Service, IRS, allows you to write off a portion of the cost of your rental property each year. As a consequence, your taxable amount decreases. This write-off is known as a depreciation deduction. When you sell your property, the IRS wants to recapture the portion of your profit that resulted from these depreciation deductions. Hence the term depreciation recapture. The role of depreciation in real estate. Depreciation is a fundamental aspect of real estate investing, and understanding how it works can significantly impact your investment strategy. Residential rental property. The IRS assumes a useful life of 27.5 years for residential rental properties. In other words, you can claim a depreciation expense equal to the property's value divided by 27.5 annually for 27.5 years. This allowance recognizes that the property deteriorates over time, reducing its value. Investment property. When it comes to investment properties, the same principles apply. The useful life assumption changes to 39 years for commercial properties. This depreciation schedule means that you can deduct 1/39 of the property's cost from your taxable income each year. The IRS offers a considerable incentive for real estate investment by allowing depreciation deductions. The catch is the rental property depreciation recapture when you decide to sell. The key is strategically planning to leverage the benefits of depreciation while minimizing the impact of depreciation recapture. Capital gains tax and depreciation recapture. Understanding tax obligations is a daunting task, especially in real estate. For every real estate investor, it is crucial to grasp the concepts of depreciation recapture and its implications on the capital gains tax. What is capital gains tax? Capital gains tax is levied on the profit you make when you sell an asset that has appreciated in value. This asset can be anything from stocks and bonds to a piece of art or even real estate. Capital gains taxes in real estate. In real estate, a capital gain is the difference between the price you sell a property for and the price you initially paid for it, assuming the selling price is higher. You are obligated to pay capital gains tax on this difference. There are strategies to offset these taxes, such as reinvesting in another property through a 1031 exchange. Relation between capital gains tax and depreciation recapture. Depreciation recapture and capital gains tax are two sides of the same coin when selling a property. On the one hand, capital gains tax deals with the profit you make on the sale. Meanwhile, depreciation recapture focuses on the tax benefit you received from depreciating your property over the years. Depreciation recapture is the tax paid on the depreciation claimed when you sell the property. Tax rate for property depreciation recapture. The depreciation recapture tax rate might vary based on several factors, but it is generally taxed as ordinary income. For instance, the maximum current rate in the United States is 25%. There is a notable difference compared to the potentially lower long-term capital gains tax rate. Paying the depreciation recapture special capital. Gains tax when and how much. You must understand when you need to pay the depreciation recapture taxes and how much you are obligated to pay. Depreciation recapture taxes are typically due in the year you sell an asset. The rate can be as high as 25%, depending on your income and the type of asset. This tax applies to the portion of the gain attributable to depreciation, not the entire gain. How to calculate depreciation recapture. Knowing how to calculate depreciation recapture is important for a real estate investor. Calculating depreciation recapture involves a few key figures, which are adjusted cost basis. Adjusted cost basis equals purchase price of the asset, plus improvements minus depreciation deduction. Your starting point is the adjusted cost basis of your property. This is the original purchase price, plus any improvements made, minus the depreciation you've claimed over the years. Depreciation expense. Next, you need to understand the total depreciation expense you claimed while owning the property. Correspondingly, this value, along with the sale price and adjusted cost basis, is used to calculate the depreciation recapture. Handling these taxes is incredibly complex and depends on each investor's unique situation. Therefore, we advise you to consult a tax advisor to understand the full implications of your investment. Impact of depreciation recapture on taxable income. In most cases, the impact of this tax leaves investors in shock as it increases their taxable income considerably. As a real estate investor, you must be fully aware of the significant tax implications of depreciation recapture when considering selling a property. Ordinary income versus capital gain. The distinction between ordinary income and capital gain is crucial when you discuss depreciation recapture. Typically, a capital gain is the profit you make from selling an investment, such as real estate. In addition, this gain is generally taxed at a lower rate, which is fantastic news for investors. The IRS considers the portion of the gain due to depreciation recapture as ordinary income, not capital gain. Contrary to capital gains, ordinary income is taxed at a higher rate. This usually comes as a surprise to investors at the time of paying taxes. Hence, it is important to be aware of all complications. Impact on cost basis. Depreciation recapture also affects the cost basis of your property. The cost basis is what you paid for the property plus any improvements you made. Not to mention, depreciation deductions lower the cost basis of the property. Consequently, a lower cost basis means a larger capital gain when you sell. So, while depreciation deductions can provide tax savings in the short term, they can lead to a larger tax bill when you sell. Before we continue with the video, take a quick moment to hit that like button and subscribe if you haven't yet. And don't forget to ring the bell for notifications so you never miss out on our latest updates. Plus, we've got some helpful resources in the description. Check them out and share your comments after you're done watching. The role of tax deductions. Tax deductions, such as the depreciation deduction, can help reduce your overall taxable income by deducting a portion of the cost of the property each year. Remember that these benefits are not free. They come with the obligation of depreciation recapture. Strategies to avoid or minimize depreciation recapture. When dealing with assets like real estate, you might face a depreciation recapture tax when you sell the property for more than its depreciated value. No magic wand can help you wave away potential taxes when dealing with depreciation recapture. Strategic tax planning and knowing when and how much to pay can make a difference. Let's delve into some ways to sidestep the pitfalls of depreciation recapture. A popular strategy you can adopt to avoid depreciation recapture is a 1031 exchange, named after its IRS code. It allows you to defer capital gains and depreciation recapture taxes by reinvesting the proceeds from the sale of a property into a similar one. By rolling over your investment into another property, you effectively kick the can down the road, allowing you to defer paying taxes until you sell the new property without reinvesting. Another strategy is to convert your rental property into your primary residence. You'll need to live there for at least 2 years out of the last 5 before the sale. The IRS allows the exclusion of up to $250,000 in capital gains for individuals and $500,000 for married couples filing jointly from the sale of a primary residence. Also, remember that these strategies are not one-size-fits-all. Therefore, it is advisable to consult with a tax professional to understand which strategy works best for you. Remember that the goal is to minimize tax liability and maximize investment returns. Using tax loss harvesting to offset depreciation recapture. One of the strategies that can help mitigate the impact of depreciation recapture when selling a rental property is tax loss harvesting. This approach allows you to offset some of the taxes owed by realizing losses in your stock portfolio. Let me explain how it works and how it saved me over $20,000 in taxes one year. What is tax loss harvesting? Tax loss harvesting is a strategy where you sell investments in your portfolio that have decreased in value, realizing a loss. These losses can then be used to offset capital gains from other investments, including the depreciation recapture from selling a rental property. By strategically realizing losses, you can lower your overall taxable income, which can significantly reduce your tax bill. How to execute tax loss harvesting. 1. Review your portfolio. Start by identifying stocks or other investments that have lost value and are currently sitting at a loss. 2. Sell the losing investments. Sell the investments that have decreased in value to realize the loss. Be mindful of the wash sale rule, which prevents you from repurchasing the same or a substantially identical investment within 30 days before or after the sale. If you violate this rule, the loss will be disallowed for tax purposes. 3. Offset gains. The realized losses can then be used to offset any capital gains you've realized during the year, including those from real estate transactions subject to depreciation recapture. If your losses exceed your gains, you can apply up to $3,000 of the remaining loss against other income, with any excess losses carried forward to future years. My experience with tax loss harvesting. I employed this strategy one year when I faced a significant tax hit from depreciation recapture after selling a rental property. By carefully harvesting losses from my stock portfolio, I was able to offset a substantial portion of the recaptured depreciation. This move saved me more than $20,000 in taxes that year. This strategy requires careful planning and a good understanding of your investment portfolio, but it can be a powerful tool in reducing the tax burden associated with real estate investments. It's another example of why understanding the full scope of tax implications beyond just the perceived benefits is crucial for long-term financial success in real estate. Am I obligated to pay depreciation recapture if I take a loss on the property? Depreciation recapture is the gain realized by the sale of depreciable capital property that must be reported as income. Depreciation recapture is assessed when an asset's sale price exceeds the tax basis or adjusted cost basis. The difference between these figures is thus recaptured by reporting it as income. If you sell the property at a loss, that is, for less than the adjusted cost basis, there would be no gain and no depreciation recapture. It's also worth noting that the amount subject to depreciation recapture is limited to the extent of your overall gain on the sale. Where does depreciation recapture go on 1040? Depreciation recapture on the sale of a property must be reported on IRS Form 4797, titled Sales of Business Property. After filling out this form, the calculated depreciation recapture amount is transferred to your Form 1040 and reported as ordinary income on line 6, total income of Schedule 1, which is an additional form associated with the Form 1040 tax return. What are IRS rules regarding capitalization and depreciation of rental property? The IRS requires rental property owners to capitalize and depreciate the property over its useful life, rather than deducting the full cost in the year acquired. For rental buildings, the cost is depreciated over 27.5 years. On the other hand, for commercial property, it is depreciated over 39 years. Investors can depreciate improvements over a similar timescale. Routine repairs and maintenance costs can be deducted in the year they are incurred. It's essential to consult a tax advisor for specific advice. Will I pay rental property depreciation tax if I hold the property for 1 year or less? If you hold the property for 1 year or less, you are still entitled to depreciate it for that year, but it will be prorated based on the number of months the property was in service. After selling the property, you would be subject to depreciation recapture, which means you would need to pay tax on the amount of depreciation you claimed or could have claimed. Underscoring the significance of rental property depreciation recapture for real estate investors is crucial. Savvy investors understand that the tax implications of selling a rental property are as essential as the acquisition and management phases. While potentially intimidating, the concept of depreciation recapture doesn't have to be a stumbling block. Not to mention, by seeking professional advice and maintaining a detailed record of your property's depreciation, you can confidently navigate this territory. You must remain mindful that real estate investment isn't merely about seizing opportunities, but about understanding the landscape. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.